There's one mistake that real estate investors make all the time. And I mean, even seasoned investors like me can make this mistake. And it's a simple mistake, but it can totally be avoided. As a matter of fact, you can turn it to your advantage with just a little bit of strategy. Today, in this episode, we're going to talk about the number one strategy to avoid that mistake, and not only to avoid it, but to capitalize on it. Hi, I'm Desi Arnaz, professional investor, and I've been investing in real estate since 1982. That's a long time. But even with that background and that history, I still made a mistake during the last recession. The mistake that I made is a kind of a rookie mistake, but most people don't really think about it. I didn't separate the equity in my real estate from my real estate investment. Now, that may sound like a strange thing to say, but here's what I want you to understand. When you own a piece of real estate and you pay a certain price for it and you have a loan on it, and that property value goes up, now you have equity in that real estate. Most people love the fact that they have equity in their real estate. In fact, oftentimes you'll see people paying down the balance extra fast so that they can have even more equity in their real estate. But equity in real estate is nothing but paper. Right? It's just paper money. It's not real. Unless you can tap into it and use it, it's nothing. And as a matter of fact, real estate values will go up and real estate values will come down. And it doesn't matter what your equity position is. That's what happens with real estate. But once the real estate value goes up and you have equity, how can you protect that equity from a downturn? That's what I'm talking about. Most real estate investors, even most homeowners, don't take the next step in order to protect that equity. What happened for me during the last recession was very simple. I had a bunch of equity in my real estate. I had paid $400,000 for this particular house. It went up to almost $1 million. That means I had a ton of equity in that real estate. But I didn't tap into that equity. I just let it sit there in the property. And then during the recession, what happened was I saw the market starting to soften. And so I put my house on the market as quickly as I possibly could, and I listed it for sale. But what was happening is the prices were falling. Right? You guys might remember that. The prices were falling. So I originally listed it at $900,000. It didn't sell. I dropped it to $850, but the prices were still falling. It didn't sell. I dropped it to $800. It didn't sell. And you get the picture, right? And that just kept happening over and over and over. And I was literally watching my equity just go away. Ultimately, that house sold at foreclosure auction for $400,000, pretty much what I had paid for it when I built it. That's what I'm talking about. Now, that didn't have to happen in my life. If I had used a strategy that I'm about to explain, I could have still kept that equity even if I lost the real estate. So here's how it should work. If you have equity in real estate, you need to pay attention to this. As a matter of fact, you need to do this. Separate your equity from the property. You see, in my example, I had, $500,000 in equity in that real estate. If I had borrowed as much of that $500,000 as I possibly could, maybe in the home equity line of credit or cash out refinance, then I could have taken that money and I could have done some other things with it. I could have, for example, put it into my dynasty trust. My dynasty trust is earning, on average, 6 to 9% interest each year. Now, if I had borrowed that money at 5%, which I could have, then I could have invested that money at 6 to 9%, and I could have actually been making money. Even when property values fall, because I pulled my equity out and I have it in cash, I'm not going to lose my equity position in that property. That money is mine, even if the property values fall. That's the mistake that I made. I left my equity in the property, and when the property values fall, my equity literally evaporated into nothing. So at the end of the day, not only did I lose the real estate, I also lost my equity that I had. You should never let that happen, okay? Take it from a guy who's been there, done that. That's not a good way to do things. When you have equity in your real estate, you need to pull it out. Now, I know that a lot of you don't want to tap into your equity for several reasons. A big reason is you don't want to have a higher mortgage payment, and I get that. But you can always use arbitrage. I should have been using arbitrage, and I didn't do it. Arbitrage basically is this. If I can borrow money at 5% and I can put it to work at 8%, then I'm earning a 3% spread. That's my 3% arbitrage spread. So in other words, I'm earning more money on the equity than I'm actually paying in additional mortgage payments. And so that earnings actually covers the higher payment. But at the same time, it also protects that equity so that I won't lose it even if the property values fall. You see that? That's what the wealthy do. So now that you guys get that picture, here's what I want you to know. You need to have a place that you can put your money, that you can get a good return, that you can count on. And what I suggest is setting up a dynasty trust, right? I like to call it the working man's dynasty trust, a WMD. Not a weapon of mass destruction, working man's dynasty trust, okay? So that's the WMD that I'm talking about. So you set yourself up a working man's dynasty trust. That trust, if you set it up the way that we teach, that trust will be earning you from 6 to 9% year after year after year. And you can tap into your equity at less than that and earn the spread and arbitrage yourself and protect your equity. So I hope you found this message really insightful and eye-opening. If you're sitting on equity, now is the time to pull it out. Get your hands on it. Now, if you don't know how to set up a dynasty trust, if you've never heard of a dynasty trust, what you'll want to do is head on over to my website. It is called investbrilliantly.com. And at investbrilliantly.com, you can learn there how dynasty trusts work. You can tap into my YouTube channel from there. You can even join our investor network. It's called the American Wealth Builders Network right there. And at the American Wealth Builders Network, you can join for free. You'll be amongst people like yourself, right? Investors and entrepreneurs that are doing something and making some moves in their life. It's a place where you can connect, you can network, and you can meet some wonderful people that are actually doing things. You can join that network by heading over to investbrilliantly.com. Now, if you're watching this on YouTube, do me a favor and do yourself a favor. Like the video and then subscribe to my channel. Then join the American Wealth Builders Network. At the network, we'll get a chance to connect, and maybe you and I can even do a deal together at some point. Well, there you go, guys. I hope you enjoyed that. I'll see you over on the network.